Hi everybody, I'm Dean Barber, founder and CEO of Barber Financial Group. Welcome to the monthly economic update. I am doing this one day early here. We're Thursday, the 28th of March. Obviously tomorrow is the end of the month, so you're not going to get a full quarter's view of what's going on, but what I'm about to show you is, I think, really critical that you understand what's happening in the world of money. And not just in the world of the stock market, but we're going to spend some time talking about some history of the bond market, and we're going to also look at what I believe is a corporate earnings recession on the horizon and potentially an economic recession on the horizon. Nothing to be alarmed about because they're cycles. The economy goes through expansion cycles, the economy goes through contraction cycles. Business cycles go through expansions and contractions. They're all normal cycles. So let's start out by looking at what the stock market has done so far this year. You're going to see, oh my gosh, this is one of the best quarters that we've seen in recent history. And anytime we've had a quarter this good, that means that the next quarter is going to be good and the whole year is going to be great. But there's a lot of contradicting information out there right now. Let's start by just looking at some of the different indexes year to date. You can see on this chart that pretty much every single index, doesn't matter which one it is, the rising tide has lifted all boats. And we're seeing gains in the first quarter in the pure market. On the high end from the NASDAQ at 15%. On the low end, we've got coming down here to look at Dow Jones Industrial Average up 9.82%. So it's the laggard at 9.82%. Let me expand this out over a 6-month period though here, and I want you to take a look at what's really going on. All right, now all of a sudden, what was our darling, and the NASDAQ's not really doing so great. Nothing, look, we're negative across the board here over the last 6 months. Small caps down 11%. Best is the RSP equal weight. And you've got an average, say 4 or 5% negative over the last 6 months. And you can see this huge trough that formed here in the month of December. Now, we've seen this huge run up so far this year, and that's where all the positive, news is coming from. However, I want to bring it back to what's really going on today. And it doesn't make any sense. There are times in the market where emotions and news will drive the market more than fundamentals. However, fundamentals are always important because at the end of the day, it's always about fundamentals. Short periods of time, fundamentals may not make any sense, and the markets may do something totally different than what fundamentals say they should be doing. As an example, check this out, all right? So this is, so far this year, the earnings per share change on the stocks in the S&P 500 in this solid line here. So what do we see? We see a direction where the earnings per share change is going negative, and not just negative in a little bit, it's going negative significantly. And at the same time, stock prices are climbing. Now, fundamentally, you got to have earnings. Fundamentally, the company's got to be growing earnings in order for stock prices to increase long term. One of two things is going to happen here. Doesn't take a genius to figure it out. Either the earnings are going to catch up with the stock prices, or the stock prices are going to catch up with the earnings. The projection for corporate earnings this year is down from last year. And in fact, you're seeing more negative revisions on companies in the S&P 500. And there's also something, I'm not really going to talk about this much this month, but I maybe do this next month, is talking about this enormous corporate debt bubble that is, I think it's actually formed and could potentially burst if we do see an economic downturn. Now, let's go to interest rates. There's been a lot in the news about this inverted yield curve. Now, I've been talking to you for the last 6 months, pretty much every single month, about how the yield curve has been flattening, which simply means that you can get almost as good of a yield on a short-term treasury as you can on a 10-year treasury. Well, guess what? That yield curve is now inverted. So I can get, as of the date that I'm recording this, about 2.45, 2.46 on a 3-month treasury. I go to a 10-year treasury, I'm at 2.38. which simply means that if you're going to loan money to the government in the form of a treasury for a short period of time, 3 months, they're going to pay you more interest than if you agree to hold that money there for 10 years. It doesn't make any sense. It inverts the yield curve. So you got a higher yield on the short end than you do on the 10-year. Ignore the 20 and the 30 because those really don't come into play when it comes to the economic forecasting. So what I've done here is on the right, we have a chart of the S&P 500 going back to 1999. And what I want to point out to you is, first of all, a normal yield curve. So a normal yield curve is going to look something like this. Short rates are lower, long rates are higher. This would be what would be called a normal yield curve. The longer you agree to leave your money on deposit, the more interest you get. Now, I'm going to flash back here to 1999, okay? So in 1999, this is January of 1999, we see the stock markets here. We all know that we were in the middle of the dot-com bubble, and the yield curve was relatively flat. But as we move forward here, look what happens to the yield curve. We come up here, all right, look at this. August of 2000, my yield curve inverts. I've got higher yields on the front end, or the short end, than I do on the long end. Now I want you to just take a look here. What happened to the stock market when that yield curve inverted? The stock market starts to fall. Fed pushes down rates, we come back to a more normal yield curve, but that doesn't mean that the pain in the stock market is over. All right, now when you get down here and you kind of hit that bottom, then you get a really steep yield curve. You get much lower lows here and higher highs here on the long term. And as the markets recover and economies recover, you get that steep yield curve. And that steep yield curve stays in place. Now I'm going to roll out here. Now the market's been going up, it's up, it's up, it's up, it's up. Now all of a sudden here we are, late 2006, look what we get. We get another inverted yield curve. Now the market continued on up here and the yield curve remained flat, inverting more, inverting more. All of a sudden in the mid 2007, we have a strong inversion on the yield curve, but the market continued on up here for a few more months, but eventually that inverted yield curve told us that we were going to have a recession. This was the 08 financial crisis. And then we've come out of the 08 financial crisis. Markets are going up. We see the steep yield curve here again, very, very similar. And then let's fast forward up to when we started talking about this last year. We said, okay, look what's happening. This yield curve is flattening. Here we are in February of 2008. The short yields are starting to catch up with that 10-year yield. And as we move forward, here's December of last year, August, October, September, here we go. So here's November of 2018. That yield curve still is not inverted. Now they're closer than what they were before, but if we fast forward that to today, look at what we've got. We've got the short-term yields higher than the 10-year yields. We have an inverted yield curve. All we have to do is take a look at the last 3 times it inverted, here, and now here. The question is, when is the recession going to hit? How deep will it be? And how will it impact the markets? We live in Kansas or Missouri here. We're in the Midwest. All right, we know this. When the storm clouds form and the tornado sirens blow, it's time to take cover. Okay? We don't know if the tornado is going to hit us or not. We don't know when it might, and it may not. I'm telling you this because I think that what we're seeing here is the formation of the storm clouds. We could continue to see the markets inch up over the course of the next several months, but this inverted yield curve is telling me from a fundamental perspective that in the not too distant future, there's probably going to be some pain in the economy. We're at the end of the economic cycle of expansion and threatening to go into an economic cycle of contraction. You're going to get all kinds of opinions on this. Some people are going to say, no, it's different this time. Fundamentals are fundamentals though. And again, we could see the markets continue up. We could see the economy continue to, eke out its 2% type of GDP growth over the next 2 or 3 quarters. But as this gets a little bit further along, it's clear, based on what the bond market is telling us, that we're not going to see the expansion in the future that we've seen over the last few years. and more likely we will see a contraction. So we compare that data and that knowledge with what we see on the earnings per share from corporations on this chart and what stock prices have done. It leads us to believe that what we have is emotion and news driving the markets. And what I mean by emotion and news is this: Jerome Powell drove a freight train into the stock market in the fourth quarter of last year. He kept saying, we're raising rates, we've got to get back to normal. And not only are we raising rates in 2018, we're going to raise rates 2 or 3 or maybe 4 times in 2019. And all of a sudden, Powell acquiesced the day after Christmas of 2018 and said, well, maybe we won't need to raise rates next year. Let's wait and see. And now he's saying probably not. And now all of a sudden you're getting this, well, maybe the Fed will cut rates. So that news, that emotion is what's causing the stock prices to soar at the same time that you've got corporate earnings declining. From a fundamental standpoint, this makes 0 sense, which means that it's probably going to look more like this. You get these exciting times right here. We had a drop up, drop up, and then all of a sudden, here's the real deal. Same thing happened here, 2007 and 8. Same thing we got going on here. I believe that this could be a top, and in fact, September 20th of last year could be the top of what we see for the market for quite some time. Now, that doesn't mean that you make wholesale changes to your portfolio. What it means is that you sit down with your advisor. Don't put this off. We're not clairvoyant. We can't read your minds. We don't know what emotions are going on inside of your head. You need to talk to us. Talk to your advisors here at Barber Financial Group. Have them walk through with you how your portfolio would likely withstand a recessionary period. Talked about what the plans are for your particular portfolio, and most importantly, how it fits into your overall long-term game plan. Because as I said at the very beginning of this video, recessions are normal. Expansions in the economy are normal. Contractions are normal in both business cycles and economic cycles. It's not something that can be avoided. It is something, though, that we can stress test within your financial plan to say, are we positioned the right way to make sure that you can accomplish everything that you want to accomplish? We look forward to seeing you in the office. We look forward to talking to you. Thank you so much for spending some time with me today.